Good morning and welcome to Markets Live here on a Tuesday morning, June 30th, the end of the quarter. And we're got a lot of things going on. Looking forward to talking with you about a whole bunch of stuff going on in the markets, from earnings to news to economic reports to lines in the sand and all kinds of other stuff. We've got the markets behind me. We've got the news going on. We got lots of folks in the chat room. Let's see, all kinds of people here from Long Island, San Francisco, all over the place. So glad to have you all in. Sergio, good to have you in this morning. So we will, from the Big Lake, I'm guessing that's one of the big lakes up north. So glad to have you all in. Good morning, everyone. So we have a bunch of stuff to talk about. Let's see what that's going to be. So I will pull up, let's see here. Where is the, let's see here, the live stream. There we go. Had the wrong PowerPoint up so that I could give you a little bit of clarification on what we're going to talk about. Let me get down here out of your way. I'll move over to one side or the other. Let's try down here. So I'll get out of your way first, and then we'll move back to the other side, and we will talk about what's happening here today. So we're going to jump in and look at several things. This continuing whipsaw market. I wrote draw a triangle so I can remember to do that on the chart when we get to it. And we're going to talk about those key lines in the sand. How good have those lines been? They have been a tremendous guide over the past weeks, and we'll take a look at those as well. And classify the market's spirit animal. So that'll be a little bit of fun. We'll do that next. And then it's just all the same thing that we've been talking about for months. The virus and the China news pushing down, stimulus and fear of missing out pushing up, and that's keeping the markets where it is. We'll come back and talk about a couple of these other things first. Let's get to the charts and get to that so that we can talk about what's happening here in the markets. And I'm going to continue to make sure that I have our chat up. So by the way, get some, if you want to look at a stock or two at the end of our time today, we'll try to make sure that we have enough time to look at a stock or two on our charts. So let's talk about a couple of good things. I talked about drawing that rectangle in this whipsaw market. Let's do that, the continuing whipsaw market. So let's pull up let's see, one of these says rectangle. There it is. Let's start down here. That's probably about right. And then we can look up to those highs all the way to where we are here. And you can see that if we do that, we've got one or two tails in fairness. Let's blow this up a little bit. There we go. We've got one or two tails in fairness right here that are outside the line. If I can get my drawing tool there, we got one there and one there that are a little bit outside the box, and so we could extend the box down a little bit. That's fine, but you can see that that bottom line there is holding pretty darn well, and that's what's got us. Now, as I look inside this line, let's pull up a couple of other meaningful lines. Go back to here, and you'll remember we have talked about this important area here where we came up and tried to get through from the bottom. It was resistance. Then we broke through. It became support multiple times, and it has extended over as our current resistance. So let's draw that, remove that, and draw it on our chart. And this is going to be, so we're going to get those bottoms, those tops right there. Again, you can see, tried, broke through, couldn't get through one more day in February as the coronavirus news really hit home, and then down we went. Came back up. We tried earlier in early June, tried to get through there and couldn't, and now we're down. Now we're down, up, down, up, down, up. Every down day, every significant down day, like say Friday, is met with an up day, like Monday. And that market, that pogo market, leads us to our spirit animal, our market spirit animal. Back here, of course, the bear. Coming up here all the way, if we go much further back, we were, of course, the bull. And today, I loved this characterization. Today, we are the kangaroo. So that is today we are in the kangaroo market, the up, down, market. Let me jump out to the other side. I'm just remembering that I'm on my PowerPoint side of the screen. If I move over here, that'll get me away from anything that we could get in our in the way if we get something on the right side of the chart. So there's a lot going on yesterday. I think there was some John B's asking about the big market move yesterday. If we look at erase all of this. John, if we look at yesterday 5-minute chart, you'll see it even here on the cash index. There was not a specific, here's the thing, I think there was some closing orders that had to be filled yesterday to balance out ETFs. Now we're getting near the end of the quarter today. We might see an end of the day bounce like this again today, up or down. As a matter of fact, JP Morgan said there were billions of dollars of outstanding orders that needed to be closed by the end of the quarter. They've been beating that drum, expecting it to push the market down. Didn't work out yesterday. We'll see if that comes home to roost today. So I hope that helps there. Thanks, Val. Yeah, the kangaroo. That's the kangaroo market is sort of where we are. So if we look at our box there, we've also got one other key line in addition to our rectangle that we've talked about here last Tuesday. We've talked about it in the afternoon outlooks before that. We talk about it in the trading dark edge trading room every morning. Let's look at this moving average line down here. This is the 200-day. This is the 200-day moving average, and that is holding up the bottom of the market. Now, of course, right below here, we have the 618, which was formed market resistance for a couple of weeks back when we were trading in this box. So when we were in this box, we've got that 618 right below us. So 3,000, obviously a big round number. Right now, the moving average, it's showing up here at 3,021. Then down here about 2940, we have that. So those are the levels. It's this zone, really. If you think about it, the market doesn't respond to single points on the chart. But this zone here in between the bottom of the rectangle, the 200-period moving average, and the 618 Fibonacci retracement is going to be a key period of market memory that's going to form a support under the market. As long as we stay above that, the market is still in neutral to bullish territory. It's not even thinking about calling it a bear or turning bearish at all while we're above those levels. And those key levels help guide our trading day in and day out. So with that said, we got all of those things, or a Tigger. I like that, James. I like being a Pooh fan myself. Very good. So here's what we have left on our chart to talk about. Just once again, why is this happening? Why are we getting this? Pushing down on the market. We've been talking about this for months. COVID-19, health and economic impact. And also now we have to throw in with that as we've got to throw in China, and of course trade with Europe. We had some trade tariff talk that disrupted the market for a day or two. But the China news just yesterday, new talks of sanctions on the new Hong Kong direction. China has made it clear they're going through with that. On this, it's going to become law on the eve of the 23rd anniversary of Hong Kong becoming part of China, which is 27 years sooner than China said. China said they would not. They said they would not put these draconian measures on Hong Kong, reduce civil liberties, do the things they're doing. And the U.S. is making actions. They're not selling high tech there, doing a bunch of different things, a bunch of sanctions on Hong Kong as a favored trading partner. So all of that battle, we'll continue to hear about that. That was just in the news overnight as well. But we've got all of that pushing down, and the pushing up, of course, is the stimulus dollars and the optimism that comes from fear of missing out and the reopening. So we've got all of that keeping us in a sideways box now for 2.5 weeks. How much longer can it last? A good while longer. We've seen these things happen, but the breakouts will come. The breakout from this level will come, and it's a pretty wide box if you think about it. You know, we're going up to about 3170, down to about 3,000. So that's 17. That's a 5% box that we're banging around in. That's a lot of room to bang around, but it's still a sideways market any way you slice it for the last 2.5 weeks. So Ruby, yes, election risk. I agree with that, and I believe that, China, India, good point. Yes, that's part of the mix. China is really flexing in lots of different areas. South China Sea, all over the place. Somebody mentioned, do we look at the defense stocks? So that's possible. I know a lot of people, one of my colleagues talked about Raytheon earlier this week. I believe it was Tom. But my favorite remains, and on this pullback could be a good place to get into Lockheed. I like Lockheed because they do a lot of defense stuff, obviously, but they're more than defense. So that's one that you could look at. But I believe the defense stocks have been beaten back a little bit because we're into kind of a risk-on stocks, and defense stocks are thought of also in the defensive category, the risk-off kind of stocks. So we'll look on that. Okay, real quick, Naveed, for Boeing. If we look at Boeing yesterday, the big day up, they're starting the certification process after that big slide down. Yes, a defense stock. Yes, they're going to have trouble getting back out there. And you've already seen Airbus said they expect 40% fewer shipments through 2021. Boeing's only major competitor. They're at that duopoly in the big jets. Obviously, there are Embraer and some smaller airframers, but the two big airframers, Boeing and Airbus. So we've got to pay attention to what Airbus said. And I don't think this is a long-term to the moon play. I believe Boeing's not going to be allowed to fail. But other than that, I think you pick it up on these deep pullbacks like we just got. I think that's a good idea, maybe not so much on the breakouts. So there are some thoughts. There. Okay, let's go back now and look. We want to talk about, there are some things in the COVID world out there. I think most everyone knows what's happening there, but just in case, let me give you a preview of what I'm going to be talking about in an article probably this weekend in Straight Up Profits. If you haven't subscribed to Straight Up Profits, you can tune in there. And here's what people are going to be talking about, looking at in the markets. The market is watching coronavirus cases over the past 2 weeks. This is the red line is a 7-day moving average you can see here. And over the past 2 weeks, you can see what's happened. We've gone up, up, up. New cases, highest levels of new cases last week. Now, we can say a couple of things about this. We are getting a spike, a surge, however you want to call it. I believe, along with Dr. Fauci and many others, this is not the second wave. This is the continuation of the first wave. We've never dropped it. Look, this number never dropped off enough. It barely dropped below 20,000 in this whole range. It hasn't dropped off enough to say that we're through with the first wave. We're still in the first wave by any way, shape, or form you measure it. But here's the thing, here's the competing forces. Yes, we are getting more new cases, and the new cases, we're also getting some higher level of hospitalizations in a few states, not in most states. So that too is concerning. We're getting a higher level of positive tests out of all, so we are doing more testing. Not so much over the past 3 weeks, to be honest, but the facts show. And the number of tests that are coming back positive are growing. So the percent positive that curve is growing. We have against that the mortality, how many deaths we're getting, how many deaths we're having per new case is dropping. I think that's the one thing that continues to give the markets optimism. So we'll keep an eye on this, but globally things are really in a bad way in many parts of the world. South America in general, Middle East growing. Then we have the subcontinent, India, Bangladesh, Pakistan, that whole very densely populated area where cases are growing. So it's going to continue to be on traders and investors' minds, something for us to watch closely. So with that, and I'm going over just real quick our COVID news here. So this is from last week. Sorry about that. I removed it once, but apparently my save didn't work there. So let's talk about earnings real quickly, and we'll look at a couple of those. I think there's some really interesting ones out there. Then we'll talk about some trades to consider, some pullback candidates that we'll look at, and they might not surprise you, but they're certainly worth looking at. And here's what we're going to look today, this afternoon, FedEx reports, and interestingly, Steelcase reports. And you see who else we got? We have Constellation, General Mills, and we have Fizz, who was supposed to report last week. We talked about it right here on the show Tuesday last week. They moved their reporting date. We'll talk about them because they are quite interesting. So let's pull this off, and then we can pull this off as well, and we'll get back and look at a few ideas here on these stocks. So look at FedEx. FedEx used to be the stock that everyone talked about as an economic barometer when they were shipping everything, when they were still tied closely to Amazon, when they were shipping documents all over the place for all kinds of companies. Electronic document moves to electronic documents have reduced that. They've reduced their tie to Amazon, and I believe that FedEx, the report that they're going to give, probably isn't going to be too optimistic. They might not even give forward guidance. We'll see what they give. It'll be interesting to see if they say anything about the new competitive threat from Amazon as a delivery company. So we'll hear about that, but you can see it's little wonder to see what's holding this down. Let's look at this 200-day moving average the whole way through. Everywhere it's met this down-sloping 200-period moving average, FedEx has dropped. That's a series of lower highs, the absolute definition of a downtrend. This is a stock that's in a bit of trouble, I think, in the intermediate term. So it'll be interesting to see what they come out with. Not necessarily the earnings numbers themselves, but what they talk about for guidance and what's happening going forward. So also this afternoon, we have, interestingly, yesterday, just because it's a sign of the times, we had Herman Miller, which is MLHR, I believe it's backwards. There we go, got that one right. And Herman Miller reported yesterday. We can't see what happened except that they're down just a little bit. They reported lower earnings, lower forward guidance, and I think we're going to see that same thing with Steelcase. So the two big high-end office equipment manufacturers, Steelcase also reporting this afternoon. Here's Steelcase. It looks like you could lay those charts on top of each other, then they'd be the same. And I'm expecting Steelcase to not have great numbers this morning. However, look what's happening pre-market. They're inching up pre-market, so we'll keep an eye on that. But of course, that's just pre-market trading. That might be one tick. I haven't checked. I'm guessing that Steelcase is going to be not the place we want to be in at all right now with any of our money. So the other ones that we have going on tomorrow, we have Constellation Brands. For those of you who are in Nikkei, looking at the pot stock world, they will probably tell us a little bit about what's going on with their investment in Canopy. They exercised their option on the 1st of May, just a month and 2 months ago, to pick up the remaining possible shares from their original purchase of Constellation. So they've bought the maximum number that option, that original transaction where they bought 35-ish%. I think they're up to 38 is about all that they went up to. But that they exercise the option is positive for the pot stock world for sure. So we'll keep an eye on what's going on with Constellation, and then a couple of others. I believe this is the big sell the news play here. I believe that you can see that as through the early part of the pandemic, look how General Mills barely went down at all, and it makes sense. Packaged goods, people are going to be buying more stuff. If you're going to be stuck at home, quarantine, it makes sense that they had this big, oh, they're going to do great. Well, maybe not. Oh, they're going to do great. But then they have been priced as very high, priced like they're going to have gangbuster numbers. So if they have anything short of spectacular numbers, I think we'll see General Mills sell off when they report tomorrow morning before the open. Now, back to last week's candidate for Sell the News, which now has become this week's candidate for Sell the News. You can see that Fizz sold off a bit with some of the other stay-at-home stocks over the past week. They were going to announce last Thursday, then they pushed it back to today. I believe that, again, another stock that's been priced up, people buying La Croix. This is the parent company of La Croix sparkling water, and I believe that they are going to be a sell the news candidate, that they are not going to live up to the high expectations that the price has been bid up to here. So with that, we had the earnings light because we're at the very tail end of earnings season, so kind of a light week earnings-wise. But we do have a couple of numbers that we need to keep an eye on today. Consumer confidence coming out at 10. That's a big number. People are looking for it to have picked up quite a bit since last month, and I believe that will happen. I believe we'll see that happen. That probably won't be a big surprise in that number. If that number does surprise, especially to the downside, that could weigh on the market a bit. But I think one of the other things the market's going to be watching, and I think John earlier asked about what moved the market right at the end of the day yesterday, is that at 12:30 today, we have Powell before the House of Representatives. Last week he gave testimony before the Senate, this week to the House. So we'll see if he has any new thoughts there. He has his prepared statements already came out yesterday. So we'll see if anything hits tomorrow during the unprepared part of that presentation later today, 12:30 today. So there's some of the news that's fit to print, what's going on out there. And I want to give you a couple of pullback candidates to look at, because I believe that the pressure that we're seeing in the boycott on Facebook is going to be, you see yesterday it already bottomed out, probably at a pretty key level. Yesterday morning it bottomed out right here. You can see that where it had a resistance was broken through, it tried here, became sort of a support level here, broke through cleanly, came up here. You can see for a couple of weeks we bounced around that level. It came back and tested that level again. I think anywhere in here between 210 and 220, you can buy Facebook for a test back up to 245. I'm not saying Facebook's going to the moon immediately. I'm saying if you want to have some in your portfolio for a company that's growing revenues 20% year over year, it's not the worst idea, and buying it on these pullbacks is the place to do it. So somewhere in this 210 to 220 level for over the next month or two, a recovery back up, because we'll see how bad the July we'll probably get some more negative news on other companies that are going to join the boycott Facebook in July movement, the boycott advertising on Facebook movement. Those pullbacks into this region, into this zone, will be good places, I believe, to pick up Facebook. And down in sympathy, in the internet duopoly, in the internet advertising duopoly, of course, is Google. And they pulled back, and then not as deeply as you would expect as Facebook, but they also pulled back and then recovered yesterday. You might think that this dollars not spent on internet advertising and Facebook might go to Google, might people say, well, we can redirect some of that spend toward Google, that ad spend toward Google. That didn't seem to be the case in how the stock was reacting. It was getting pushed down with Facebook. So we'll see, but I think both of those candidates, as this gets pushed back, anything close to hitting the 200-day moving average and recovering for Google, another growing double digits, growing double-digit revenues, one of the biggest companies, Facebook and Google, 2 of the 5 biggest companies in the world. They're going to continue to do well as long as they grow those revenues. With the issues that people have right now with Facebook and the boycott in July are certainly no worse, and in many ways less worse than the personal data breaches that Facebook has suffered in the past. So I believe, just from a pragmatic standpoint, whatever side you're on how bad or not so bad the Facebook ads that they've allowed to run, et cetera, are, if you can put aside your political leanings, it's still a stock growing 20% a year. That's all I got to say about Facebook. Okay, let's look at some of your stuff. Let's look at some of your stuff in the window here, and we'll talk about. Let's see. I saw some earlier. People coming in. Hey, New Jersey people coming in. We got looking up. Several different stocks to look at. So I think that, let's see, did we have something else we talked about? Yeah, we talked a couple of weeks ago about Lennar, and yesterday we got some good numbers that came out on Lennar, and I just like the homeowners in general. I talked about that 2 weeks ago, that I like the homeowners. Lennar had a pullback since then, but if you look at Lennar, you look at Pulte, they are a little weaker than Lennar. You look at Toll Brothers, weaker than Lennar. D.R. Horton, my namesake, they are a little bit stronger. So D.R. Horton and Lennar are acting better than the other home builders right now. But I think that's a place that the pent-up demand, people haven't been buying homes, and now they're starting to do that again, that pent-up demand issue, and the longer-term migration from big city. For many decades, we were going from suburbs into the city. The re-citification of people, there was a migration into cities. I think now with the pandemic, we're going to see a short to intermediate term migration back out of the city into the suburbs, and stocks like Pulte, DHI, Lennar. I like Lennar better than Pulte again. And DHI, I think those two are doing the best out of from a stock perspective out of those. So there we go. So Wells dropped their dividend. They're just the weakest bank right now. You can see they're still hugging the bottom of the page, where you get Goldman, who are, up in the middle, at least the middle of the range, and flirting with their 200. You look at JP, who gets to keep their dividend. JP not doing as well. JP Morgan, one of the universally acclaimed better run of the banks, but not doing as well as Goldman right now. And you look at Bank of America, looks almost exactly like JP. Citi looks almost exactly like JP and Bank of America. And Wells Fargo, the cheapest one of the bunch, and probably going to continue to be the weak trade out of all of those. So let's see. We look at a couple of others. We'll look at a couple of others on. We got MSCI is one request here, as and from the chart perspective, we look at what they're doing, and let's see. What do we get? Are these? I can't remember. I can't remember what MSCI does. Maybe you can throw a note in there. I think, are they real estate? I believe that's correct. So they do some. Looks like they are trading. They look like they're trading like a REIT here, but I don't know. We got from 340, 330 down to 220. So they only broke down about as much as the market. So that's pretty good. Stayed above their 200 except for a couple of the worst part of the virus. And now they're up making new highs. Not making, looks like got a couple of levels to watch there, but don't particularly love or hate what's happening with them right here. Let me see who asked about that. I think it was John. So let's look. Okay, we got somebody's asked about two different of the travel stocks, travel casino stocks, AAL, and AAL continues to be the weakest of the airlines. So you get DAL looking just a little bit better, and from a balance sheet perspective, AAL and UAL are certainly two of the more under fire of the airlines. I just think we're going to be a long time before we're starting to fill up planes again. Not fill them up. We're filling them up because they're only running 40% of the flights that were running pre-COVID. So planes are full, just filling up the system. We're not going to be doing that anytime soon, I don't believe. So same for MGM. I think they have a little bit different perspective in terms of what's happening with their resort business and their gaming business kind of put together. Will that come back sooner rather than later? Buying them on these pullbacks is a possibility if you want to buy it. If you're going to not look at this for 12 months, then you can buy some of these. You can do some bottom fishing in some of these stocks, but there might be some better places to put your money to work unless you're just trying to go for the home run. So let's see what else we've got out there. FSLY, and and you can see what's happening with it's just another one of those that just completely took off. And now, if you own this, and it just as a public service announcement, for the Fastly folks, is that if you own this, please be sure that that you have a get out point. When this thing goes asymptotic up the Eiffel Tower on one side, you got to have your get out point for when it comes down the Eiffel Tower on the other side. Now maybe it stays up here forever. They're another one of the cloud companies that had just done really well in the work at home world. So new world, but yesterday, a big range day, a big outside down day, which would give a candlestick technician a reason for pause. But I just think have your get out level. If you got in back here in the 20s, make sure you don't let it trade back down to 30 before you get out. So that's my only advice there, because I haven't really dug into the financials of Fastly and can't really speak to how well they're doing to sustain this kind of move up. So we talked about Boeing just briefly earlier, kind of a defense stock, and I'm thinking that one of the things that one of the ideas that we have with Boeing is that they are going to got a bump yesterday because of the recertification, but Airbus just came out and said that they're cutting back, they're reconfiguring, they're taking a loss. So they're basically a very similar stock to Boeing. Take a quick look at Boeing and some dark pool data. Just for grins. Let's see how they did yesterday. So with that big up day, they were slightly bullish. So you might expect that. And their options flow, however, it looks like wasn't particularly strong yesterday for such a bullish trade. There's 11 million shares, 3 million shares worth of options, 2 million shares. That's a whole bunch out of the top 5. Looks like we have negative options selling on 4 of the top 6. big options blocks that went off, reported through the dark pools yesterday. So I'm not sure I'm a huge fan of Boeing in the near term for the next few weeks for that, but we'll see if that comes to fruition. So we talked about the cruise lines. Just throw them in with with American, and worse yet, I believe people are going to be less ready to go cruising, to be people in a small spaces for long periods of time, like on a cruise ship. They're going to be less ready to do that than other things recreationally for a while. So I think cruise ship recovery is down the road more than many of the other ones. So let's hit a couple of these other ones real quick. Naveed asking about consumer discretionary. I'm assuming that's what you typed in the symbol for consumer discretionary. They have done really well. Risk on. Look at them versus the consumer staples. You can see the risk off trade portion of that duo is below the 200-day. We can see it's below the 200-day moving average here and couldn't get through it, while consumer discretionary did get through. You can see it got through and then stayed above. It even got to a new all-time highs. So that's largely because of the makeup of consumer discretionary. I believe Amazon's in there, so that helps them out a bunch. So we've got some other smaller stocks, I&O. So we got I&O out there, and they have been doing just great, up and down, up and down. It's the talk about bouncing around the last few. Volatility, thy name is Innovia. So remember, up one side of the Eiffel Tower, have a get out point. Not saying you got to do it now. Could they continue to climb? But we've gone up from a few dollar stock. We've gone a 10x. Especially if you were in here, you got to be taking some off. If you've already gotten a 10 bagger, take a little bit off anyway. Pay yourself. But have a get out point. Where is your get out points? Probably not 30, because that's within the average true range of this thing. It's probably not 25, but then right there you got to start thinking somewhere in this area you don't want to give back all of those gains, and maybe even have a get out and then a re-entry if it trades back down into here. So, but do have a get out point on I&O, and I think fundamentally they're doing a lot of great things. And when they did this, everybody goes, "Oh, they were done," and then they've done it more times. So I&O, I know a good friend Bill Padalon has interviewed their CEO a couple of times, and he thinks the world of the company from a fundamental perspective. So they're doing some really innovative, good things, and they could continue to shine in this COVID world, especially with the folks that they're working with. So that's it. So a couple of more real quickly. We're looking at some. So the Qs, the Nasdaq, still the place you want to be. The triple Qs. If you want to ride that volatility, that's something you can play for a couple of weeks. You don't want to pay it for a couple of years or a couple of months because of the nature of those leveraged ETFs. We're talking about TQQQ, which is the leveraged triple ultra Q ETF. And so you can see here where the old Qs got up to their all-time highs. If we let's just look at the Qs, and we'll see that they got to their all-time highs and broke them here, where the triple Qs did not, because of the nature of the day-to-day compounding of the rebalancing of a leveraged ETF. So that's what's going on there. So if you're wanting to leverage your money there, you might look at some option spreads or something else. If you've got a short-term opinion, then you can use the TQQQ. Okay, so that's a bunch of them. We're 5 minutes from the open. We got to let you folks get ready to get out there, get the open. I got to get ready for the trading room at the Dark Edge Project. Join me there if you haven't already, 10:35. Every morning, and we'll look forward to seeing Sergio and some of the other folks here. I believe John, there's quite a few other folks here that that will be in the Dark Edge trading room. We'll look forward to seeing you there. And yeah, for SPY, we've already talked about that earlier. Alex, you want to catch the recording because we got to jump. But I gave you the numbers that you've got to look at. They're right there. We're going to continue to trade in between here. A breakout above the blue line or below the 200-day moving average is going to be significant for spiders. So there you go, folks. Glad to have so many of you on. Hope that you have a great rest of your day, a great rest of your week. Stay safe out there. Help yourself. Help someone else if you're able. And God bless you.